Right now, at this exact moment, something is happening to your money, and most people have no idea. Gas prices are surging. Groceries cost more than they did 3 months ago. The news keeps saying words like inflation, interest rates, recession, and nobody stops to explain what any of it actually means for the number in your bank account. So let me break it down. Simply, no jargon, no panic. Just what's happening, why it's happening, and exactly what you should do about it. Because I've seen an economy break before. I'm the one who broke it. And the 5 moves I'm about to give you, they're the difference between coming out of this stronger or coming out of this broke. Here's what most people don't understand about what's happening right now. Oil prices have jumped over 80% since the start of this year. And oil isn't just what goes in your car. Oil is in everything. The truck that delivered your groceries ran on it. The factory that made your clothes was powered by it. The plastic in your phone case came from it. When oil goes up, everything goes up. It just takes a few months for the wave to reach your shopping cart. That wave, it's called inflation, and it's here. Consumer prices are up nearly 4% from a year ago. That means something that cost you $100 last year cost you almost $104 today. That doesn't sound like much, but multiply that across every single thing you buy: rent, food, gas, utilities, insurance, and you're spending thousands more per year for the exact same life. And here's the part that makes it worse. Your paycheck probably didn't go up 4%, which means you didn't get poorer because you spent more. You got poorer because everything around you got more expensive while your income stayed flat. That's not a budgeting problem, that's an inflation problem. And it's the silent tax that nobody voted for. But here's where this gets interesting, and I mean personally interesting to me. Because what's happening right now, rising prices, panicking consumers, a government that can't decide whether to raise or lower interest rates, I've seen this before 700 years ago. And I was the one who caused it. When I walked through Cairo in 1324, I gave away so much gold that I flooded the market. Gold became so common that its value collapsed. Prices for everything in Cairo skyrocketed because the currency was suddenly worth less. It took 12 years for the economy to recover, my bad, but I learned from it, and what I learned is exactly what's going to help you right now. What happened in Cairo is exactly what's happening today. Different cause, it's oil and geopolitics this time. Not a king with too much gold, but the mechanics are identical. Too much money chasing the same amount of goods. Prices rise, purchasing power drops, people panic. The question isn't whether this is happening. The question is what you do about it. And that's where most people freeze. They see the news, they feel the anxiety, and they do nothing. They wait for it to fix itself. They hope their paycheck catches up. They absorb the damage. That's not a strategy. That's surrender. Here's what I did after I crashed Cairo's economy. I didn't pretend it wasn't happening. I didn't wait for it to fix itself. I borrowed gold back from Cairo's moneylenders at interest, specifically to pull excess gold out of circulation and stabilize the market. I engineered a correction. I took action based on understanding the mechanics, not based on emotion, a 14th century correction. And it worked. You can't fix the global economy, but you can protect your position within it, and there are exactly 5 moves that work during times like these. I'm going to walk you through all of them. And honestly, move 3 is the one that most people get completely backwards. It might be the most important 60 seconds in this entire video. But let's start at the beginning. Move 1. Know your inflation-adjusted number. Most people know their income. Very few know their real income, what their paycheck actually buys after inflation. If you make $50,000 a year and inflation is 4%, your real purchasing power is $48,000. You lost $2,000 this year without spending a single extra cent. You didn't buy anything. You didn't make a mistake. Inflation just took it. Like a pickpocket you can't see. Here's the upgrade. Open a spreadsheet or a notes app right now, or right after this video. Write down your monthly take-home pay. Subtract 4%. That's your real income. Budget from that number, not the one on your paycheck. This one adjustment prevents the slow bleed that catches most people off guard. They budget based on what they earn. You budget based on what your money actually buys. That gap is where people quietly go broke during inflation. And the people who see it, they're already playing a different game. But knowing the number is only step 1, because there's a way to lock in your costs before they rise any further. And most people don't realize the window is closing. Move 2. Lock in your fixed costs now during inflation. Prices rise. That's the definition. But not everything rises at the same rate. Variable costs, gas, groceries, utilities fluctuate with the market. You can't control those, but fixed costs, your rent or mortgage, your car payment, your insurance premium, can sometimes be locked in. If your landlord is offering a lease renewal, sign it now before they raise the rent. If you can refinance any debt to a fixed rate, do it now before rates climb higher. If your car insurance is up for renewal, shop around and lock in the best rate today. Every fixed cost you secure at today's price is a wall against tomorrow's price increase. Mansa Musa's empire survived droughts and trade disruptions because the core infrastructure was built to absorb shocks. Your fixed costs are your infrastructure. Lock them down, and every dollar you lock at today's rate is a dollar that won't inflate against you for the length of that contract. That's not saving, that's shielding. Now here's where it gets counterintuitive. Because the next move is the one that 90% of people get exactly wrong during times like these. And getting it wrong could cost you hundreds of thousands of dollars over the next decade. Move 3. Don't stop investing. Accelerate. Cash is becoming a liability. Let that sink in for a second. This is the move that separates people who survive inflation from people who profit from it. When prices are rising and the economy feels scary, the instinct is to hoard cash. Pull money out of the market, stuff it under the mattress, wait for things to calm down. That instinct is wrong, and it's expensive. Let me show you why. Inflation means your cash is losing purchasing power every single day. $1 today buys less than $1 6 months ago, so hoarding cash during inflation is like trying to save water in a bucket with a hole in the bottom. You're not preserving wealth, you're watching it evaporate. Here's a contrarian truth that sounds wrong but isn't. During high inflation, savers tend to lose ground and long-term investors are usually better positioned. Cash is a melting ice cube. But assets, stocks, real estate, commodities tend to rise with inflation. That's not a coincidence. That's the math. I've seen this before. People in Cairo hoarded gold after I crashed the market. That gold kept losing value for 12 years. The people who moved their gold into trade goods and infrastructure, they recovered in 2. Same wealth. Different decision. Completely different outcome. But the stock market? Historically, equities are one of the best inflation hedges that exist. Companies raise their prices during inflation, which means their revenues go up, which means stock prices tend to follow. Over every 20-year period in the S&P 500's history, the market has produced positive returns. Every single one so far, including periods of war, recession, and inflation far worse than today's. Past performance doesn't guarantee future results, but the pattern is hard to ignore. The people who invested during the 2008 crash, the 2020 pandemic, and every scary economic moment in between, they're the ones sitting on the largest gains today because they bought when everyone else was selling, and compounding did the rest. Here's another contrarian truth. The safest feeling strategy is often the riskiest. Holding cash feels safe, but it guarantees you lose purchasing power. Investing feels risky, but it's the only strategy that has beaten inflation over every long time horizon in modern history. Don't stop your automatic investments. If anything, increase them. Dollar cost averaging, putting the same amount in every month, regardless of what the market is doing, means you're buying more shares when prices are low. When the market eventually recovers, as it historically has over every long period, those cheap shares become your biggest winners. The people who invest during chaos build fortunes. The people who hide during chaos rebuild from zero. Mansa Musa didn't stop building trade routes during difficult years. He built more during difficult years because he knew the infrastructure would be worth 10 times as much when stability returned. Your investments are your trade routes. Keep building. Okay, so those first 3 moves, protect your money and grow it. But there's a defensive layer most people completely ignore, and skipping it is like building a kingdom with no walls. One siege and everything you built gets wiped out. Move 4. Build your emergency fund to 12 months if you can. In normal times, 3 to 6 months of expenses is the standard recommendation. During economic instability, stretch that to 9 to 12 if possible. Here's why. Recessions mean layoffs. And the hiring market during a recession is brutal. It can take 6 to 9 months to find a comparable position. If your emergency fund only covers 3 months, you're in credit card debt by month 4. And credit card debt during a period of rising interest rates? That's compound interest working against you at the worst possible time. Here's a contrarian truth. Inflation actually rewards debtors, but only the right kind of debtors. If you have a fixed-rate mortgage, inflation is quietly shrinking what you owe in real terms. But credit card debt at 24% that rises with rates? That's the kind of debt that eats you alive. Your emergency fund is what keeps you from ever falling into that trap. Even an extra month of cushion makes a difference. If you're at 3 months, push to 4. If you're at 6, push to 8. Every extra month you add is another month of freedom. Freedom to be selective about your next move instead of desperate. Freedom to say no to a bad opportunity because you're not panicking. That cushion doesn't just protect your money, it protects your decisions, and your decisions are worth more than your money. Now the 5th move is the one nobody expects in an economy video, but it's the one with the highest return of all 5, and it's completely immune to inflation, recession, and market crashes. Move 5. Invest in yourself, the inflation-proof asset. Prices go up, markets go down, interest rates swing. Currencies fluctuate, but your skills, your knowledge, your ability to earn, those don't depreciate with inflation. They appreciate with application. During economic uncertainty, the people who get laid off last and hired first are the ones with skills the market can't easily replace. This is the time to learn something valuable. Not next year, not when things calm down, now. Because when the economy tightens, the people who invested in themselves during the chaos have options that everyone else doesn't. One certification. One technical skill. One negotiation course. The return on that investment doesn't depend on the stock market, the Fed, or oil prices. It depends entirely on you, and that makes it the most inflation-proof asset in your entire portfolio. No government can devalue it. No market crash can erase it. No recession can take it from you. Mansa Musa built Sankore University not during times of prosperity, but because he understood that knowledge was the one asset that could never be devalued. When trade routes were disrupted and gold prices fluctuated, the scholars at Sankore kept producing value. They kept attracting talent. They kept generating ideas that drove the empire forward. Your brain is your Sankore. Fund it. Here's what's real. The economy is going through turbulence right now. Inflation is eating into your purchasing power. Oil prices are creating ripple effects across every industry. The Fed doesn't know whether to raise rates or hold. Consumer confidence is at a record low, and none of that is in your control. But these 5 moves, these are entirely in your control. Know your real income. Lock your fixed costs. Keep investing through the noise. Extend your emergency fund. And invest in the one asset that inflation can never touch: yourself. 5 moves. Each one puts you ahead of 90% of people who are just sitting there absorbing damage and hoping it stops. I crashed an economy once. It wasn't pretty. But I also fixed it because I understood the mechanics and I took action instead of waiting for someone else to solve it. You can't fix the global economy, but you can fix your position within it. And the people who take these 5 steps now, while everyone else is panicking, will be the ones who come out stronger on the other side. When panic spreads, wealth transfers. It always has. It always will. The only question is which side of that transfer you're on. That's the code.